Super is more than just saving for the future. And when we talk about contributing to it or adding to it, there's actually a few ways you can go about it that not only can minimize the tax you pay, but score some free money for the government, all while growing your account balance. Now, today I want to help you understand the different types of contributions and the incentives available so you can grow that larger retirement fund much sooner. Let's get into it. When we're contributing to super, what we're doing is putting money into our super accounts. And we do that through three main ways: concessionally, non-concessionally, or through government contributions. I'm going to take you through all three, starting with concessional. Concessional contributions are pre-tax contributions that include money you add to your super before income tax is deducted, hence the name. The main perk here is tax savings. These contributions are taxed at a flat rate of 15% when they enter your super fund, which is likely lower than your marginal tax rate. Now, there is also something called the concessional contributions cap. This is an annual limit of the amount of concessional contributions that can be made into your superannuation. If you contribute more than the concessional cap over the course of a financial year, your excess contributions are taxed at your marginal tax rate are accounted as a non-concessional contribution. Now, in terms of what exactly is a concessional contribution, the perfect example is the super guarantee. And that's the payment that your employer pays, which is a percentage of your income to your super account. Whether you're full-time, part-time, or casual, if you're over 18, your employer should be contributing into your super account as part of the super guarantee. For those under 18, the same applies if you work more than 30 hours a week. Now, the super guarantee is a percentage of your income. By the middle of 2025, it will be 12%. So that means your employer is obligated to pay 12% of your income into your super account over the course of the year. To check how much super you're receiving, you can look at your pay slip, your payroll tool at work, or your super account to see what is going in and how often. If you want to do the maths and try to work out how much income you needed to have for your super guarantee to reach the limit of the contributions cap, that would be around $275,000 per year. So for those earning less than $275,000 a year, it's unlikely through the super guarantee that you would go over your contributions cap. And that segues me into the next type of concessional contribution that I really love and is a great way to save on tax, which is salary sacrifice. This is a voluntary opportunity for you to reduce the tax that you pay by adding more money into your super account through that pre-tax concessional contribution. Now, I've been doing salary sacrifice for a number of years and find that a lot of people find it probably overwhelming or confusing. So I just want to spend a minute and explain how it actually works so you can get an understanding, because I know people love saving tax and I just want to make sure you're fully aware of it all. All right, let's look at a specific example here. I've got Alex. He's a cool guy and he wants to know a bit more about how salary sacrifice might work for him. So let's roll through his numbers and see how the big picture will look. First of all, he earns $80,000 a year. And at 12% of a super guarantee, that means by default, he'll get $9,600 a year sent towards his super without doing anything. Alex decides he wants to salary sacrifice an additional 5% over the course of the year. So he talks to his employer about contributing that much as a salary sacrifice option. He's now contributing a total of 17% of his income per year, which is the $9,600 plus the $4,000 salary sacrifice for a total of just over $13,500. So what does that mean? That means he reduces his taxable income. So instead of paying tax on $80,000 per year, he's only paying tax on $76,000 a year. As you see in the numbers, that turns into $1,280 less in tax payable over the course of a financial year. The caveat, of course, is that he also sees a reduction in his take-home pay. So because he's reducing his taxable income, the amount of money that he gets in his pocket after tax is taken out is also reduced. And in this instance, it's a reduction of just over $2,700. That might be daunting, but if we look at the big picture, you see that Alex is suddenly putting more into his super, but paying less tax. At the end of the day, Alex will have just over $2,700 less in his take-home pay, but he will also see $4,000 more in his super account at the end of the financial year. So you can see here the gap is the amount you save in tax. And for those looking for, I guess, a tax advantage, this is one of the best ways you can do this, because you can go to an employer and ask them to process this type of strategy for you. I will point out as well, there's no set number that you need to salary sacrifice. It doesn't need to be 5% or $4,000. It could be 1%. It could be $1,000. Run your own numbers as well. I'm not here to highlight the specific numbers, but really to highlight the gap in the tax you pay if you decide to contribute more money to your super in a pre-tax environment concessionally. Let's move on to non-concessional contributions. These are contributions that are made from money that has already been taxed, such as your take-home pay or personal savings. While these don't provide an immediate tax break, they can grow tax-free within your super fund. Plus, you can contribute up to $120,000 per year, which is 4 times the concessional contribution cap. Now, there are contribution limits if your balance is $1.7 million or more at the end of the previous financial year. You cannot make any further non-concessional contributions. A couple of examples of non-concessional contributions are anything that is in excess of the concessional contribution cap. Another example is simply a personal transfer into your super account through money that you have available, whether it's from your take-home pay, whether it's from selling a piece of furniture or art, or just having a bit of cash that you want to put into your super fund. You can easily set up a BPay transfer with your fund, get the details off them, and go ahead and start adding money to your super account. That is how non-concessional contributions work. Now, I just want to spend a moment and talk about the carry forward rules. If you don't use all of your cap in a financial year and your total balance is less than $500,000 at the end of the previous financial year, you can carry forward unused amounts for up to 5 years in a concessional cap or up to 3 years in the non-concessional cap. For example, you can see in the diagram, even though you've gone below 100% of the cap in the first 2 years, you can go above in the final few years of a 5-year period to make sure you maximize your concessional cap limits. And if someone like Alex only contributes $15,000 of his $30,000 in year 1, then if he's got the final 4 years of a 5-year period to utilize the remaining $15,000. And you can keep track of your contributions either through your super fund or through ATO's online services. I highly recommend you talk to your super fund about this or do a bit further reading, but it's really useful for those who fluctuate in their income, receive windfalls, stop working, and go through a bit of change in their life so they can continue to take opportunity of the concessionally taxed environment. Now, I know many of you love getting more from the government, and this section is all about the ways we can get more money into our super fund from the government if we meet a few criteria. So I'm going to take you through a number of ways and a number of opportunities available to us. These contribution types are more like incentives or little bonuses the government offers us to encourage you to save more for retirement. I've been using a number of these over the last few years. I just want to make sure everyone's aware of them and the opportunities available to them. Let's start with co-contributions. Now, these aim at helping low to middle income earners save for retirement. The way it works is that the government will match post-tax contributions at 50% of what you put in, up to a maximum of $500. Your total income must be less than the higher income threshold for that financial year. Currently, the higher income threshold is around $60,000. There is also the lower income threshold, which is around $45,000. Anything below $45,000 will get the maximum co-contribution available, and then it tiers off between $45,000 and $60,000. You can contribute once or incrementally throughout the financial year. It doesn't matter how you contribute, whether you put in $500 once, $20 a week, or anything in between. This contribution gets paid directly to your super fund following your tax return. So this is a fantastic way for you to get your contributions matched at a really good rate. The next one is low income super tax offset. So if you have an adjusted taxable income of up to $37,000, you may be eligible to receive a refund into your superannuation account of the tax paid on your concessional contributions, up to a cap of $500. So the idea here is that you get a refund on that 15% tax that you paid on your concessional contributions. So if you earn $37,000 a year, you would be putting in around about $4,000 in contributions and paying $600 or so on tax on that. So the $500 in and tax offset would go to reimburse you for that. There's a few details to it, but the reality is if you earn under $37,000, lodge a tax return and your super fund has your TFN, then you don't need to do anything and that tax offset will be applied. Another tax offset available is the spouse tax offset. Now, the biggest criteria here is that you need a spouse. and that spouse has to earn under $40,000 a year. If you make contributions into your spouse's superannuation account and they earn less than the $40,000 per year, you may be eligible to claim a tax offset. You can claim up to 18% of the contributions you make, up to a maximum offset of $540. This is a really good way to get a tax offset, all while contributing to their spouse, who gets the benefits of their super balance growing. I've personally been using this for a number of years, and it's a great combination with the co-contributions we just talked about. So you can get nearly $1,000 if you combine those two together over the course of a financial year. Now, the tax offset reduces when your spouse's income is greater than $37,000 and phases out when that income reaches $40,000. There's a bit of calculations on how the offset is calculated, but you can go to the ATO website to get the full breakdown of how that all works. Final one I want to show you today is downsizer contributions. If you are age 55 or older and owned your home for more than 10 years, you may be able to contribute up to $300,000 per person or $600,000 per couple from the sale of your house into your super fund. This is treated as a non-concessional contribution and doesn't count towards your contribution cap. However, the downsizer contributions count towards your transfer balance cap, which applies when you move your super into retirement phase and is taken into account when determining your eligibility for the age pension. This is a fantastic way for you to turn, your home equity into a retirement income stream. Again, I encourage you to read up on this, call your super fund and talk to them and see how that might be an option for you. Most of the information from today's video came from the ATO website. I'll put plenty of links in the description below. While you're there, please like and subscribe if you enjoy this type of material, so it gives me a sign that I should be making more. For now though, let me know what contribution type you love taking advantage of the most. Crunch your own numbers, give your super fund a call if in doubt, but go ahead and create your own retirement plan. All the best.